Role of gold. In an environment of uncertainty and aggressive monetary policies, gold becomes a more attractive asset. Unlike currencies, gold cannot be printed, which gives it a sense of stability and long-term value. Investors often turn to gold as a form of protection against financial risk, inflation, and currency devaluation. It is also unique because it carries no counterparty risk, meaning its value does not depend on the performance of a company, bank, or government. Because of these characteristics, gold is often seen as a safe haven during periods of economic instability and market volatility. New normal. Over time, these policies have created what many call a new normal. This environment is defined by consistently low interest rates, high levels of global debt, and ongoing central bank intervention. In such conditions, borrowing becomes easier, and both governments and companies take on more debt. At the same time, investors are encouraged to take on more risk in search of higher returns. While this supports economic activity in the short term, it also creates long-term challenges that may not be immediately visible. Hidden issues. Beneath the surface, several hidden risks continue to grow. Corporate debt levels have increased significantly as companies take advantage of cheap borrowing. Investors are also exposed to higher levels of risk, often without fully realizing it. Markets may appear stable, but this stability is heavily supported by central bank policies. This raises important questions about long-term sustainability. If conditions change or support is reduced, the financial system could face new periods of instability. Pandemic 2020. In 2020, the global economy came to a sudden stop due to the COVID-19 pandemic. Businesses closed, travel was restricted, and entire industries were put on hold almost overnight. In response, central banks acted faster than ever before. They introduced massive monetary support programs to prevent economic collapse. Liquidity was injected into the system on an unprecedented scale, ensuring that financial markets continued to function. This rapid reaction helped stabilize the situation, but it also significantly increased the amount of money in the global economy. Policy actions. To support economies during the pandemic, central banks implemented extremely aggressive policies. This included effectively unlimited quantitative easing, where asset purchases were no longer restricted by a fixed amount. Governments also stepped in with fiscal stimulus, providing direct support to businesses and individuals. This included subsidies, loans, and financial aid programs designed to keep economies running. Together, monetary and fiscal policies work to maintain stability, support employment, and prevent widespread bankruptcies. Effects. The effects of these actions were immediate and significant. Financial markets recovered bisurat, even while the real economy was still struggling. At the same time, the money supply expanded rapidly, reaching levels never seen before. This created new dynamics in the economy. One important concept that emerged is the Cantillon effect, which describes how newly created money benefits those closest to the financial system first. This can lead to increased inequality as asset holders gain more than others. Inflation returns. After years of low inflation, prices began rising again. Energy costs increased significantly, food became more expensive, and everyday services started to cost more. This rise in inflation was driven by multiple factors, including supply chain disruptions, increased demand after the pandemic, and the large expansion of the money supply. As a result, the cost of living increased, and many households began to feel financial pressure. Central bank response. To control inflation, central banks changed their approach. Instead of supporting the economy with low interest rates, they began raising rates rapidly. Higher interest rates make borrowing more expensive, which slows down spending and investment. This helps reduce inflation over time. At the same time, central banks started tightening monetary policy by reducing asset purchases and shrinking their balance sheets. Consequences. These policy changes had immediate consequences. Loans became more expensive, making it harder for individuals and businesses to borrow money. Financial markets reacted with increased volatility, and many asset prices began to correct after years of growth. In this environment, gold regained importance as a store of value. Investors once again looked for assets that could protect against uncertainty and inflation. Gold in portfolios. Gold plays an important role in investment portfolios, especially during times of uncertainty. It is often used as a form of protection against market volatility, inflation, and currency devaluation. By including gold in a portfolio, investors can achieve better diversification. This means that not all assets react the same way to economic changes, reducing overall risk. Over the long term, gold is valued for its stability and its ability to preserve wealth across different economic cycles. Real examples. In real life, many individuals and businesses turn to gold as a way to protect their financial position. Some people choose to save a portion of their wealth in physical gold to guard against inflation. Businesses may also use gold or other hard assets as part of their long-term survival strategies, especially in uncertain economic environments. Analysts often observe that during periods of crisis or instability, demand for gold increases as confidence in traditional financial systems weakens. Investment strategy. A balanced investment strategy typically involves a mix of different asset types. This can include stocks, bonds, real estate, and commodities like gold. Regular investing over time helps reduce the impact of market fluctuations and lowers overall risk. It is also important to monitor interest rates as they have a strong influence on asset performance. By combining diversification, consistency, and awareness of economic conditions, investors can build more resilient portfolios. Dark side. While these policies helped stabilize the economy, they also created several negative side effects. One of the most important issues is the survival of so-called zombie companies. These are businesses that are not profitable but continue to operate because borrowing is cheap and financing is easily available. At the same time, systemic risks remain hidden beneath the surface. Markets may appear stable, but this stability often depends heavily on continued support from central banks. Another consequence is growing inequality. Those who own assets, such as stocks or real estate, benefit the most from rising prices, while others fall behind. Gold versus Bitcoin. Gold and Bitcoin are often compared as alternative assets, but they are fundamentally different. Gold has a long history as a store of value and is widely trusted across the world. Bitcoin, on the other hand, is a relatively new digital asset. It has a limited supply, similar to gold, but it is much more volatile and less stable. While both can be used as a hedge against traditional financial systems, they serve different roles. Gold is typically seen as a safe and stable asset, while Bitcoin is considered more speculative. Key lesson. The key lesson from all of this is that the amount of money in the system can grow much faster than real economic value. This creates imbalances and shifts wealth toward those who own real assets. As a result, protecting wealth becomes increasingly important. Investors need to understand how the system works and adapt their strategies accordingly. In a world of constant monetary expansion, assets like gold and other real investments play a crucial role in maintaining long-term financial stability.